Her name is irrelevant. Her title is Bank Secrecy Act Compliance Analyst Level 2. She has worked this job for 4 years. She has a master's degree in financial regulation. She is good at what she does. She is also, at 2:14 p.m. on a Tuesday, about to file a federal report on someone who did nothing wrong. She doesn't know yet. That's the part that matters most. She is about to do everything correctly. She is about to follow every procedure, apply every standard, use every tool her institution has given her. And she will never know she got it wrong. Today, you're inside her workstation. You're making the decision. The asset guardian. Before we follow her through the next 23 minutes, you need to understand what she's actually doing. Not what most people imagine she's doing. Most people, when they think about financial compliance, picture a detective, someone building a case, gathering evidence, pursuing a suspect. That is not this job. A BSA compliance analyst is not a law enforcement officer. She cannot arrest anyone. She cannot subpoena records. She cannot compel testimony. She has no investigative authority whatsoever. What she has is a standard. Is there a reasonable basis to believe that this transaction involves funds derived from illegal activity or is designed to evade reporting requirements? Reasonable basis to believe. Not proof, not certainty, not probability beyond a reasonable doubt, reasonable basis. That bar is low by design. The system was built that way deliberately. Because the theory behind it is sound, law enforcement can't investigate what it doesn't know about. The compliance officer's job is to surface suspicion, not resolve it. Investigation is someone else's function. The problem is that surfacing suspicion and confirming innocence are not symmetrical processes. If she files and the person is innocent, the report sits in a database. The person is never told. The law enforcement agency that might have investigated never does. The bank keeps the account open, processes future transactions, behaves normally. Nothing visibly goes wrong. If she doesn't file and the person turns out to be criminal, her institution faces regulatory penalties, potentially enormous ones, the kind of penalties that end careers and trigger consent orders. The incentive structure of this system rewards filing, always, regardless of what the account holder actually did. She knows the incentive structure. She also knows the account. What does 23 minutes inside this decision actually look like? 2:14 p.m. She opens the flagged transaction. $9,400, outbound wire. Recipient, a supplier the account has transacted with 17 times over 2 years. She notes the amount. She pulls the threshold, $10,000. The gap, $600. She pulls the transaction history, filters for all outbound wires to this recipient over the account's lifetime. She looks at the chart for a moment. She has seen this pattern before. She has also seen it explained away, legitimately, 100 times. Suppliers invoice in specific amounts. Contracts define payment structures. Business doesn't always come in round numbers. She notes the pattern. She moves to the next flag. Velocity deviation. This month, 4 outbound wires. Account average 2 to 3. She checks the account for business seasonality. Is there an industry pattern that would explain an uptick in outbound payments this month? She can't determine that from the data she has. She notes it, moves on. She stops here longer. The supplier has appeared in other institutions' suspicious activity reports. Not convicted, not charged, not investigated. At least, not that she can confirm. Appeared. She cannot access the contents of those SARs. The database shows existence, not detail. She doesn't know what those other institutions saw. She doesn't know if those reports resulted in any action. What she knows is, the supplier has been flagged before, and her account holder sends them money regularly. She notes it. Flags 4, 5, and 6. She works through them the same way, methodical, professional. She is not rushing to a conclusion, she is building a picture. And here is where the process becomes something worth watching carefully. Because at no point in her review, not once, does she have access to information that would tell her why. Why was the amount $9,400 and not $11,000? She doesn't know. The account holder had an invoice for $9,400. Why were there 4 wires this month instead of 2? She doesn't know. There were 2 additional clients who paid, generating additional payables. Why does the supplier have an elevated risk score? She doesn't know. The supplier processes payments for multiple businesses in a cash-adjacent industry, and one of those businesses was flagged 2 years ago by a different institution for different reasons. The context that would explain every single flag on this account is sitting in a filing cabinet in someone's office, in invoices, in contracts, in email chains, in the lived reality of a business that operates legally, has always operated legally, and will continue to operate legally after this report is filed. She cannot see any of it. The system doesn't have a mechanism for her to see it. The account holder doesn't know they're being reviewed. The gag order prohibits the bank from telling them. The review process has no provision for their input. They are the subject of the decision and absent from it simultaneously. At 2:31 p.m., 17 minutes in, she finds the thing that makes the decision feel certain, and it's the most ordinary detail in the entire file. 3 inbound ACH transfers, 7 days, total $31,000. She traces each one. Client payments. The account holder runs a business. Clients pay them. They pay suppliers. This is, objectively, how a business works. But the timing. Large inbound deposits followed by rapid outbound wires. She has seen this pattern in accounts that were later confirmed to be pass-through vehicles in layering schemes. She has also seen it in every small business account she has ever reviewed. The pattern is not evidence of crime. The pattern is a behavioral fingerprint that exists in both criminal and innocent accounts. The system cannot distinguish between them, and neither, with the information available to her, can she. This is the moment. Not a dramatic moment. Not a moment with music swelling and a decision that feels weighty and cinematic. A quiet moment, a Tuesday afternoon, fluorescent light, a half-empty coffee cup, a person doing a job. She pulls up the SAR form. The form takes 11 minutes to complete. She documents the 6 flags. She references the velocity deviation. She notes the elevated counterparty risk score. She describes the timing pattern. She does not note, because there is no field for it, that the account has 6 years of clean history. She does not note that 17 prior payments to the same recipient resulted in no issues. She does not note that every flag on this account has an alternative, entirely innocent explanation. Because the form doesn't ask for that. The form asks for the basis for filing, not the basis for doubt. At 2:37 p.m., she submits the report. It transmits to FinCEN's database in approximately 4 seconds. She closes the case, marks it resolved, moves to number 13 in her queue. The account holder's wire transfer clears at 2:41 p.m. The money arrives at the supplier. Everyone goes home at 5 o'clock. Nothing appears to have happened. I want you to sit with this for a second. She didn't do anything wrong. She followed the process correctly. She applied the standard she was given. And the outcome is a federal report on someone who did nothing wrong. Tell me in the comments, where specifically does the system fail because it's not her, and it's not the account holder? So, where is it? Here is what happened today, clearly. A monitoring system detected 6 behavioral patterns in an account. A compliance analyst reviewed those patterns against a legal standard. The standard was met, not because the account holder committed a crime, but because their account produced a fingerprint that the standard is designed to catch. A report was filed. The system worked exactly as designed. That is the problem. A system that works exactly as designed and still produces this outcome is a system with a design flaw. Not a personnel flaw, not a technology flaw, not an enforcement flaw, a structural flaw. The flaw is this. The standard for filing, reasonable basis to believe, is calibrated to maximize reporting. It was designed at a moment when the primary regulatory concern was underreporting. Banks weren't flagging enough. Criminals were moving money without detection. So the standard was set low. And the incentive structure was set to punish underreporting severely and punish overreporting, filing on innocent people, not at all. The result is mathematical, not moral. When filing is rewarded and not filing is penalized, and there is no cost for filing incorrectly, the system files, every time, on everyone who matches the pattern, regardless of intent, regardless of context. regardless of innocence, 3.8 million times a year. She is not the villain of this story. That framing, the villain, the corrupt official, the bad actor, is actually more comforting than the truth. Because if there's a villain, you can remove the villain. You can fix the problem by replacing the person. What you cannot fix as easily is a system that produces predictable injustice through the correct application of its own rules. She did everything right. The person whose file sits in FinCEN's database right now did everything right. And neither of them had any power to produce a different outcome, because the system they were operating inside didn't give them one. She couldn't ask the account holder for context. The law prohibits disclosure. The account holder couldn't provide context. They didn't know they were being reviewed. The form she filed didn't have a field for reasonable alternative explanations. The database that received it doesn't annotate reports with no subsequent action taken. Every point at which the system could have produced a more accurate outcome, the system didn't have a mechanism for it. That is institutional complicity, not the malicious kind, the structural kind. The kind where the institution, the law, the incentives, and the procedure all point in the same direction. And that direction isn't toward truth. It's toward the report. Understanding this system doesn't make you powerless. It makes you accurate. The compliance officer who reviews your account is not your enemy. She is a person inside a process. The process has specific failure modes. Understanding those failure modes tells you exactly where to apply pressure, not on the person, but on the record. Document your transactions, not because you're guilty of anything, because the form she fills out has fields for suspicious patterns and no field for innocent explanations. And the only way to change what enters that form is to make your account's context visible before the review begins. A clean, documented transaction history doesn't guarantee you won't be flagged, but it changes what the compliance officer sees when she opens your file. And at 2:14 p.m. on a Tuesday, when someone is sitting in front of a dual monitor workstation deciding whether your name goes into a federal database, what they see is everything, because you won't be there to say anything. Next video, your account gets frozen at 9:47 a.m., not flagged, not reviewed. Frozen. The call to your bank takes 40 minutes. The answer they give you is 5 words. Here's what those 5 words mean and what happens the moment after you hear them. Subscribe. Because the system has a process for everything. You should know what that process is before it starts.